Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone. In today's episode of the Capital Mind podcast, we talk about the impact of taxes on investing and how the recent changes from the budget on Jan 31st, 2023 and the Finance Minister's speech towards end March 2023 impact everything from debt mutual funds to real estate to gold, foreign holdings and startups. If, like me, you've in the past held the view that you should just find the best investment and then let taxes sort themselves out, you'll find this episode full of insights on how each class or instrument type can materially change your expected returns. Another quick note, we use a lot of numbers in this episode, so we'll accompany it with a link to a public Google Sheet with some key calculations shown on it. You'll find this sheet fairly quickly when you visit capitalmind.in/podcast or just send us an email at podcast@capitalmind.in and we'll reply with a copy. Well, Deepak, this last financial year, we had a budget, I guess, end of Jan, early Feb. We thought we knew what our taxes were and were making our plans accordingly. But then things got very interesting. And last week, March, the finance minister came out and changed a whole bunch of things, particularly around, well, I guess everything outside of equity. And we've all been coming to terms with this. And so we just wanted to sort of have this discussion with you to understand how taxes and how these new rules will affect how we think about investing. Particularly so because one thing which we often hear about is, look, just pick the best stocks or pick the best long-term investments, put your money in there, hopefully you'll make 15% on your equities, and all the taxes will take care of themselves. Don't get too caught up with tax optimization and all. You'll end up making worse decisions that way. But now things have changed quite a bit. I mean, the rates have doubled, exemptions are gone. And so I just wanted to ask you, let's start with debt, since that was the one the finance minister talked about most prominently. With debt mutual funds, with her changing how we tax debt mutual funds and doing away with the indexation benefits, can you talk about whether taxes now matter for how you look at fixed income types instruments?
Shray, I think you're spot on, because I think in taxes matter in every form of investment, though we don't like to think so. And we'll go through a whole host of cases today, of course, because the idea of this entire concept is to say that while we shouldn't, taxes do impact us. While they shouldn't, I mean, we shouldn't make a decision for buying a product or not based on taxes. But taxes are a central part of the decision-making process. Now, I'll give you an example. Before March 31st, 2023,
old regime. I'll call it old regime.
The old regime or whatever.
Oh no, we can't call it that.
So let's
indexation
call it when indexation applied.
Yeah.
So FDs, for some strange reason, FD rates had gone up to some crazy extreme. Now, of course, little bit moderation is there, but then you're still getting FDs at roughly 8% a year. But debt funds were giving you 7%. So you might look at me and say, Deepak, you know what? Debt funds are less useful, inferior to FDs, because FDs are 8%, debt funds are 7%. But before March 31st, 2023, debt funds, if held for more than 3 years, were giving you an indexation benefit of 20%. So the idea of investing in a debt fund was you invested something. After 3 years, you could choose to say, listen, I'm going to pay taxes only on the gains made of whatever was higher than inflation. So you got to subtract inflation from your gains and pay tax on the rest. This resulted in a tax that was as low as, sometimes even 4% of your gains. That means if I made a gain of 100 rupees, I'd pay only 4 rupees out of it as, income tax to the government, where normally you'd be expecting to pay 33% in FD would be, in this thing. So to give you an example, before 2023, FDs are, the taxation hasn't changed, but the FD, a fixed deposit, would be taxed at an income slab throughout, which means you're paying 33% income tax on any interest paid out on a fixed deposit, which means 8% interest falls to 8 into 0.67. So roughly 5.4%, 5.36% actually, post-tax. That's the amount you get in hand after you pay the tax. The debt fund, even if it gives you just 7%, because of this massive inflation indexation, after 3 years, effective tax rate is so low that your return is 6.6%. So you only pay 0.4% to the government as a tax, which is quite remarkable, because I assume 5% inflation here. So you're making 5% minus 7%. So there's a bit of the simplest way to put it is, since I make 7%, the inflation was 5%, I really made only 2%. On that 2%, I pay only 20% of tax. 0.4% is gone. 6.6% is remaining. 6.6% is what I get in my pocket. 6.6% is debt fund, 5.36% is FD. So therefore, FD is not superior. FD is the inferior one, and debt fund is superior. I'd say take it one step further. There was an insurance endowment policy. Many of them promised 6.8% returns. 6.8% returns were fantastic because it was both pre and post tax, because insurance endowment policies had no tax if you took them out at maturity. This is great. This has changed, of course, because now you need to invest less than 5 lakh rupees per year in total across all policies to be able to get a tax-free return on whatever you've invested in, but in an endowment policy. But anything more than 5 lakhs is taxed income, but that's a different thing. I'm talking about pre-March 31st. Now, you've got a fairly interesting piece here. Taxes and the quantum of the taxes and how it applies to you changes the way you look at products. Now, take the employee provident fund. Employee provident fund used to be 8%. Now this is 8% post-tax. It's not even 6.7, 6.8, all the numbers I'm talking about. 8% post-tax with the EPF was completely tax-free. And the difference between all of this used to just be the tax rates that apply to each individual component. Now things have changed. Everything has become taxable. Debt, mutual funds. There's no concept of long-term taxation anymore. Anything that's not equity is taxed as if it is short-term capital gains, which applies to gold mutual funds. It applies to international funds as well, even if they're equity. But it actually applies largely to debt funds, and debt funds are roughly half of whatever is invested in the mutual fund market. Roughly half of it is sitting in debt, a little more than half. So they all now have to pay tax when they exit, whether they exit 5 years after they've been bought or 1 year after they've been bought, they will still be considered short-term capital gains. Insurance above 5 lakhs a year is taxable as if it's income. So there is no even indexation of the input price. You have to pay on the rest as its income. EPF above 2.5 lakhs per year, this was done last year or the year before that, is that any interest received on investments made of more than 2.5 lakhs per year, they create a separate account for that. And then they charge you interest and even TDS, I think, on that interest, so that the government collects tax on any employee provident fund contributions about 2.5 lakhs per year. The tax has changed. Definitions has changed, thought processes, and therefore your new decision-making framework will be based on a new set of taxes. The answers may be exactly the opposite of what you thought 6 months ago. We might have chosen an FD instead of a debt fund. Now we might choose the debt fund instead of an FD, and so on. The difference isn't in the product; it's just in the taxation of it.
I understand that, but in a sense, since now everything's going to be taxed as income and there's nothing you can really do about it, this whole indexation thing is kind of gone, or for many things it's gone. Isn't this now more fair? Now I don't have to actually think about the taxes because they'll all be taxed the same. So now I can literally compare the 7% on the FD versus or the 8% on the FD versus the 7% on the debt mutual fund and be like, I'm done. I know what the difference is. So what do you have to say to that?
There's another nuance, and we're only about nuances at Capital Mind, so that's it just makes it complicated. But here's the thing. Let's say you're trying to save for retirement. You're the kind of person who says, dude, I am going to put all my effort right now into making money. And when I retire, I want my money to earn returns. But you know what? I don't want equity because I am so super scared of equity. I'm this is the traditional debt investor. What will you choose? The FD or this? Let me ask you this. Now you're working hard. You're paying a tax of roughly 33% per year. Now FDs are taxed at 33% per year. So that means if you get 8% in an FD, you're going to pay 33%, and every accrual, so only the remaining money effectively gets compounded, right? So you make 8% per year, you're going to receive only 5.36%, then put that into compounding and so on. Now, there is a difference between that and a debt fund. In a debt fund, because you're now only taking the money out at retirement, every year you're not taxed on the gain. The accrual is not taxed. So the 8% remains the 8% inside the fund, keeps growing at 8%. At the point of retirement, you can actually get, in the current regime, I'm talking about the future the tax rate will be even lower in all probability, but today you can make 30 lakh rupees per year and pay only 6 lakh rupees of tax. Effective tax rate is only 20%, up to 30 lakhs of income. This is just, people say, oh, about 10 lakhs. It's not like that. The first 10 lakhs has some deductions. And actually, in the new regime, the new actual tax regime, up to 15 lakhs, it's all slabbed. Up to 7 is something, and then 7 to 9 is something. And it's a different set of rules that apply to smaller levels of income. But only income above 15 lakhs do you pay a higher tax rate. So that up to 15 lakhs, you're already paying a lower tax number. So roughly the calculation goes up to 30 lakh rupees, you will pay only 6 lakh rupees of tax, which is the effective tax rate of 20%. Now let's say you hold the money in a debt fund, wait till you are 60 years old, you have no other source of income, you cash in 30 lakh rupees of profit in a debt fund. Now this is profit because I'm saying no indexation, nothing, but you bought something at 10, it's gone to say 30 by that time, and you sell enough of the 30 to make 30 lakh rupees of profit. This is only a 20% profit. So now what's happened is you've been able to accrue every year, not pay any tax on the accruals, and at the end pay a much lower tax rate of only 20% when you exited. The lower 20% is not because it's capital gains, it's simply because you're in a lower tax bracket effectively. Now, today you can get 30 lakhs at 20% tax. Now you might say there's inflation, but you know what? As inflation goes around, tomorrow you'll be able to get 45% with the same 20% tax. So they just rationalize the tax slabs accordingly. This is a huge difference. Now I'll tell you how much the difference is. First, let's take the fact that forget the tax difference of 33 and 20%. We take just the same tax rate, 33%.
First, let's make them both 8% and both paying at 33%.
Yes, both 8%, both paying at 33%. The difference between the returns of an FD, which is about 5.4 as we calculated, and what will happen because of accruals and only accruals are taxed, the compounding of the accruals matters. After 10 years, you get 5.9% compounded. So that's 50 basis points higher. Now you might think 50 basis points is not a big deal. But 50 basis points per year adds up to a lot. For instance, for something like who has built up a corpus of roughly 1 crore rupees, you might be talking of a differential return of between 2.5 to 4 lakh rupees. So there's a fairly large difference in terms of corpuses. But take this one step further. You're 40 years today. You save for another 20 years. The 20-year differential is as much as 100 basis points. So what is 5.4 will become 6.4% in a debt fund simply because of the compounding of the accruals, although both are taxed at exactly the same rate. And now this is just the fact that you're at the age of 60 taxed at the 33% rate. Now I am saying no, let's tax you at the 20% lower rate. Then the differential becomes 5.4% remains 5.4% because that's what you're paying every year till then anyways. But that's what the FD fixed deposit is. But the upward differential, obviously it's upward, for the debt fund is 140 basis points, so 1.4%. That means they will make 6.7% roughly if they invested in a debt fund for 20 years, let the accruals compound, and then paid only a 20% tax because they're in
by virtue of being in a lower tax rate
bracket at that time. And sorry, this is 140 basis points is only for 10 years and 170 basis points for 20 years, which is quite a big difference. I'm talking, the numbers are mind-boggling. I mean, if you look at just 100 rupees in fixed deposits, 100 rupees after tax would be 284 rupees.
In, I guess, 20 years,
in 20 years. And if you choose the 20% tax bracket, it will be 393 rupees.
In a
In
debt
a
fund where you're
debt
able
fund.
to.
Yeah. So you can assume that the 284 versus 393 is a 100 rupee difference. Roughly, you're making, if you make 180 rupees of a profit in one place after tax, you're making a 270 rupees profit after tax in the other option, which is quite a significant difference. We're making 50% absolute numbers higher profit, which is quite, I don't think it's deniable that this is a good thing. So although the tax system has tried to equalize them, I think the long term accrual non-taxation actually makes it easier for people to think about this. But you have to remember one thing. That means you buy a debt fund, you don't sell it till you retire. Which means if somebody tells you there's another debt fund that's better, no, you don't sell and go into that other debt fund, because the intermediate accruals immediately get taxed then. Then it's a waste of time. You choose something that you can stay forever. And if you can't choose like a gilt fund or something that does not have this feeling that, oh my God, I need to exit this right now. No credit risk, no all of those, really weird things. But gilt funds, one gilt fund versus the other gilt fund, how much difference can there be? It's possible that some of the differences are there, but it's now in your benefit to not exit and let the accruals get taxed only when you retire. There's another good thing about this whole concept. It's all short-term capital gain. It's not income. Now, short-term capital gain, if left alone, is added to income. But short-term capital gain can be offset with losses. And one of the things that you might have, and we'll talk about later, is a loss in any investment that was short-term in nature. So it could be, for instance, a set of companies that you've bought and the market has fallen down right now. You could sell them, buy them back. The loss that is thus recognized is allowed to be offset against any of these fixed income product profits, and you'll pay a lower tax on it. Now, you could ask me, Deepak, why aren't you buying an insurance product instead? Don't they give you a better return? And they also give you money when you retire. But here's the thing. If you save 3 crores, and I was telling you that, listen, you can take out 30 lakhs at 20% tax. You might say, Deepak, you know what? I only need 30 lakhs. Okay, 2.5 lakhs a month is enough for me to spend today. I'm assuming that the inflation takes care of the rest. But at 30 lakhs a year today, I can easily live a comfortable life. I will only need 30 lakhs. So if I've put 30 crore, if I've saved 3 crores, I only exit 30 lakhs this year. Then I exit 30 lakhs the next year. So I don't actually need to exit the entire fund. I can stretch it across a period of time, right? Most insurance products may require you to exit at a predetermined time. Some of them, of course, these are they're different, and I'll come to that. But when you tell me that I have to take a certain amount of money, regardless of whether I want it or not, and I can't defer it for a few years or something like that, you realize a problem that isn't that year I have a lot of income and I'm getting taxed at, forget 33, I'm getting taxed at 39%. You're going to give me more income even if I don't want it. It's not under my control. There are, of course, certain products where they tell you, listen, we'll give you the money over a period of years. But there also, if in any of those years you determine that I have a lot of other income, I don't need this money this year, you can't say no to it. They will just give it to you. So in a way, some of this product isn't in your control, but it's not. Therefore, I don't think it's as attractive as a pure debt fund even today, which is surprising, honestly, because who defends debt funds in an environment like this?
Well, I think we used a lot of numbers, so we'll put a link to an Excel sheet or a Google sheet rather, which shows how the number calculations so that people can look at this as they go along. But to summarize, I think it was 3 points. The first is the fact that you can take out smaller amounts of a debt mutual fund when you want, and so hopefully be taxed at a lower rate, or in the years where you'll be at a lower rate. So that's one. The second one is the ability for the accruals to grow tax-free and only later pay tax. So it's not like they all offset. And the third one is how you can offset against losses as well and potentially. So those are 3 very powerful, I guess, engines you have. I get it. One thing which many people have come to us is, look, we are fortunate enough, and I think there's a lot of people in this basket or bucket where I have all these debt funds already. I had built up these over the last few years. So now what? Now should I, when say the interest rate cycle turns and things change, should I realize that profit and enjoy the wisdom of investing in this low tax product, which is no one else can get anymore? Or should I treasure these and hold on to them like metaphorical gold? Because I know we're not as fond of literal gold. But should I hold on to these as treasure or not? I guess that's my question.
I think the important thing is to look at new investments in two ways. First, if I'm getting new money and I already have a bunch of debt funds. So the way I would tell you to do things is to invest in the same debt funds if you like, or different ones, whichever ones you want. But if you are investing in the same debt funds, you should create a new folio. This is only available to people who are investing in non-demat modes. Some of these brokerages who now allow you to buy mutual funds but only sit in the demat mode, they can have only one folio. But for everybody else who's investing in non-demat investing mode in mutual funds, you can create a new folio but invest in the same mutual fund. So I have one mutual fund which has 1 lakh rupees, and then I put another 10,000 rupees in another folio. So I will now have 1,10,000 but across two folios. The reason for this is, when I need money, I can choose whichever one of the folios, because taxation is by folio, first in, first out by folio. So I can choose which folio I should exit so that I pay lesser tax. What's interesting here is, let us say if I need money to withdraw for whatever reason. So like you said, you have a bunch of debt funds, should I sell them already? Now my answer to you is, why do you need the money? Do you need the money? You shouldn't take out money and invest in another debt fund, because that sounds like, you're getting out of a favorable tax regime and getting into an unfavorable one. I'll come to why that is bad at a later point. But let us say you need the money. You need the money to do something, and this something maybe, you know what, I want to take a trip abroad. I've got this money saved, why don't I use it? So I would say, here's the deal. Don't do it. In many cases, it may make sense if you've held certain funds for a relatively long term to not sell them and pledge them instead, take a short-term loan and repay that short-term loan. There's a reason for that. People are very averse to loans, okay? And you say, you know what, you shouldn't take a loan. No. Consider this. This is a mathematical thought process. You have 50 lakh rupees sitting in a fund. Now you need 20 lakhs out of it for some urgent purpose, like, holiday. I want to spend 20 lakhs on a holiday, but you know what? I'll replenish it within, say, 3 months or whatever, some number like that. You were invested in this fund 7 years ago and it's maybe doubled, so let's say 10% annualized. Oh, fantastic. But if you do take out this 20 lakh here, because you're taking out the money after all this doubling and all that stuff, you might actually end up paying not as much as 20% of the whole amount, but you may end up paying something like 1.5 to 2 lakh rupees of tax. That means your gains may be, 6 lakhs, and 33% of that, because its taxation is 33% today for most people who are working.
But these are old funds. You're getting
these are old, so you'll get 20%. So let's say you get 6 lakhs of profit, or 6 or 8 lakhs of profit, and then you're paying 1.5, 1.6 lakhs of that as a tax. Yeah. Now this sounds terrible because you're saying, oh my God, I'm paying 1.6, but at least out of the 20, I have to pay only 1.6. The remaining money I have to use. Let me ask you this. Why don't you go to a bank, give the same funds and take 20 lakh rupees as a loan only for 3 months, because you're going to pay it back in 3 months, so you're going to replenish it in 3 months. Now you might say, Deepak, it's a loan, why should I deal with a bank? The bank will charge me 10% interest. Now remember, a bank, if it has the collateral as a debt fund, it will not charge you the highest interest rate possible. It will charge you a lower interest rate and say, okay, well, fine, since we have the collateral, we'll charge you maybe 1 or 2% above what we might have given an FD. So if an FD is 8%, I'll charge you 10%. So if you take this 10% loan for 3 months, you pay on 20 lakhs. For the full year, you would have paid 2 lakhs. So for 3 months, you'll pay only 50,000 rupees. Now let me put this in context. I take the 20 lakh rupee loan, and for 3 months, I can pay the whole amount back. I pay only 50,000 rupees as interest to the bank. That is part one. 50,000 rupees is my cost. Second, I redeem 20 lakhs from the fund, pay 1.5 to 2 lakh rupees to the government as a tax, and only enjoy the rest. This sounds a little like saying, listen, one hand I have only 50,000 rupees as a cost, one hand I have 1.5 lakhs as a cost. Why would I choose the 1.5 lakhs? Just so that I don't have to take a loan sounds like a bad idea. But of course, you have to be sure, of course, you're going to give back money back in 3 months and so on. But let me put it another way. If after you return the money, you're going to put the money back into the same debt fund, the new investments do not qualify for long-term capital gains indexation, which means you're going to take out money which was at favorable taxation rules and put back money at unfavorable taxation rules, which is even worse. So effectively taking a loan and leaving the money in the fund makes more sense. And you could do it at different quantums. You could do 5 lakhs, then take another 7 lakhs, and increase it and so on. One of our customers actually contacted us and said, we're finishing 3 years on certain mutual funds. What should we do? Can we move them to different funds? Then we said, what? Let's do the analysis from the perspective of people who are, this idea of getting out of a fund after 3 years is primarily because they've done their taxation thing, that they've done what they're supposed to do. Let's move on to something else. But we found out that if you want to move from one debt to the other, if the one debt fund which you actually have has finished its 3 years of holding and there is indexation involved, to move to another product which has no indexation requires me to have something that gives me 2.5% more. So if you're giving me, one guy is giving me 7, the other guy is giving me 7.5, that's only a 0.5% difference. The difference needs to be 2.5% for anyone to actually make a shift, assuming that you hold for another 10 years. This is amazing because it essentially means that the government has ensured that tax funds have sticky money. I mean, debt funds have sticky money. That the sticky money stays simply because it's more rational to stay in the same fund than to switch to even a better performing debt fund, because the better performance needs to be better by 2.5% a year, which in fixed income terms is the equivalent of saying, you need to be Superman and Batman and Robin and all of them at the same time.
It's bigger than it's like liquid versus corporate debt funds. So in fact, even that's not 250 bips.
No, right now it's like 20 bips.
Okay, fine.
But yeah, I mean, it could be like, super risky debt, for which I don't want, right? I mean, I'm investing in a debt fund because I don't want to take risk. So I don't think you should shift unless the tax differential is massive.
All right. No, that's quite that's quite interesting. But as you were saying this, I was actually thinking, let's move on from debt. I mean, I think the point is well made. I mean, the benefits are done. And now if you're holding on to money, what do you do with it? One example is you do get loans against securities from even places like Zerodha, right? So you could potentially use that if you don't want to visit a bank. I don't know what the interest rates are, but potentially you can do all this online without visiting the bank for taking a loan. But thinking about equity, I'm remembering there was a time not so long ago where you could invest in equity and 1 year later sell whatever you had made and there was no taxes on that. So how come now in retrospect, wasn't this the glorious heyday for investing in equities? But even today, 1 year from now, I'm only paying 10%. I feel nervous that will surely go up now given the way they've been treating everything else. But as of now, equity does look comparatively, not just but extremely favorable to all these things you've just talked.
Totally agree with you. In fact, taxation wise, this is the most weirdest thing I've seen. In debt, people flock to the product with the best post-tax return. Suddenly, when equity comes into the picture, this tax thought process completely vanishes. I'll tell you why. Equity, as you said, is 10% long term, 15% short term. Sounds like, oh, well, it's high, but you know what? It used to be 0% at some point earlier. This lower taxation should make more people invest in equity. That's what you would think. Of course, it is also evident from all our long-term charts, anything more than 5 years, the average returns of equity are above 10%. The average returns of debt at max might be 9%. So you're getting a better long-term return in equity if you hold for 5 years for the most part. Higher return, lower tax. What's not to like? Yet, more money sits in FDs, which is the worst tax product in India, compared to equity mutual funds, even for individuals. And equity mutual funds are the next highest holding for individuals. And then only after that do retail individuals buy direct equities. So literally, people are willing to sacrifice the higher longer term return, the lower longer term taxation in equity for the guaranteed returns of an FD, simply because I think they value the guaranteed return on FD much more than the volatility that comes in equity investing. And because such volatility is such a big factor in making decisions, I think people just make the relatively irrational decision. At some point, when equity was tax-free, even dividends were tax-free. Technically, you paid nothing to own stocks long term. And yet, even after the point when 2018, when the markets have switched over to having to pay tax. So you would think, no tax, more people will invest. Oh, if you introduce tax, less people will invest. You know what? Equity returns since 2018 are still 11% a year. This is 2023. It's 5 years now. Not only that, but more people are investing in equity now than ever before. In fact, in the month of March 2023, 20,000 crores went into equity systematic investment plans or SIPs last month. The lack of taxation or the lack of tax benefits does not destroy the category. In fact, you might say that possibly it helped it. So increasing the tax rate on something or equalizing the tax rate to something else might actually in the long term help an asset class rather than change anything else in it. In fact, the idea that governments want people to invest in equity is simply because they want people to be able to take risk, because otherwise the government has to protect everything. So you'd think that the taxation benefit offsets the feeling of volatility, right? But I don't think people think of it right now as an advantage. So they continue to flock more towards fixed deposits, while at the same time increasing their investments in equity, even though it is not tax beneficial to them. Now, there is a very, very big difference in the US. And we've had another podcast on this in India as well. This is a US 401k. In a US 401k, it's a very, very interesting phenomenon that you actually invest pre-tax. That means you take money and you say, this is my income, this is my salary, but I will not pay tax on the salary. I will invest it in a 401k. And when I take the money out of the 401k, because by this time it would have been invested for years and years and years, when I take the money out of the 401k, I will give it tax on that money as income completely, or the entire money. It's not even, there's no concept of purchase price versus sell price. It's not capital gains. It's just that the whole money is taxed in one shot. Nearly 40% of the US market invested by individuals comes through their 401ks directly. And if you have invested 1 lakh rupees or $100,000, $100,000 has become, let's say over time, $250,000. Your feeling when you look at that portfolio is, you might look at me and say, Deepak, I'm worth $250,000 in that 401k. What you don't tell me is, if I took that 250,000 out, I'd pay 30% tax on it, which is, or 25% tax, 30%.
Yeah.
So if you take 30% tax on that money, you might get less than or 200k or less. So you end up with a situation where you're actually thinking of yourself being worth 250,000 when you know that post-tax you're actually worth less. This adds to the wealth effect. It just makes you feel like, oh man, I'm rich. I'm richer than I actually am if I take the money out all at one shot. So there's a wealth effect in terms of a 401k. In India, there's a similar thing in NPS. In NPS, if you keep investing in an NPS, let's say the balance becomes 1 crore rupees, only 60 lakhs out of that 1 crore rupees is tax-free if you take it out after retirement. 40 lakhs has to be placed in annuity. Annuity returns are taxed. So effective tax rate is like 20% or so. So you might, or not 20%, about maybe 4 into 3, about 12% or so. So your 1 crore is actually worth only 90 lakhs to you. But you don't think of it as worth 90 lakhs. You think of it as worth 1 crore. So it makes you feel a little bit better.
Fair. I'll just use the example on stocks, the same one which you would use for debt, which is, let's say you're sitting on a stock right now that's hasn't done so well recently, but has historically been a performer. Would you circle out of that and invest into, say, something that's looking better right now, just given what you've been talking about taxes?
This is actually quite interesting because taxes have a complexity now that we are getting taxed on the profits in stocks. It entirely depends on the structure of the portfolio that you've built. Now, for instance, let's say one of the best stocks in India has been Asian Paints. 2020 to 2023, Asian Paints has given us 67% in absolute terms. However, the Nifty itself is up 103%. I think, dude, how come you have a great company in India which in a 3-year period has underperformed the Nifty by 40% in absolute terms? Why don't I shift from Asian Paints to the Nifty? Now, this may actually be complex because such things have also been noticed for companies like Bajaj Finance, HDFC Bank, and such companies, great companies, just that they haven't done as well as the Nifty. Now, let's say you knew this in advance. say, oh, next 3 years, the Nifty is going to do better. And maybe better is 40%, maybe better is 20. I don't know what that number is, but let's say that number is, you knew exactly how much that number was. Here also taxation plays a role, because exiting the Asian Paints investment has a certain amount of tax. That tax could be just 10%, let's say. But if you had 100 rupees and, let's say all of that was profit because you bought Asian Paints, I don't know, some ways of Anna back. Of course, there are some rules around 2018, but just, humor me, So let's say that 100 rupees was entirely profit. You'd pay 10% of it to the government and only be able to invest 90 rupees in whatever else you're doing. So 90 rupees doubling will become 180, is equivalent to keeping Asian Paints, and if it went up 80% in the same time the Nifty went up 100%, so Asian Paints could underperform the Nifty by 20%, it would still make no sense to exit it to go to the Nifty, even if you knew it upfront and beforehand. So the profile of the return has been made worse in a taxation situation, and a suboptimal decision, which sounds like, oh, you know what, why would I give up 20% or 30% return just like that? The answer is, well, you know what, you're not getting that extra 20-30% because you'll have to pay tax in the interim.
I'll move on to a couple of different asset classes. I'll name 3 and you can just go through them one by one. MLDs, which I personally never really understood. Gold, which is impacted now, and real estate. Well, I guess all 3 are now impacted, but just could you talk us through all 3 of these examples?
Brilliant. Okay. So you could have a product that's trying to mimic equity. That is what a market-linked debenture was supposed to be. That said, okay, listen, if the Nifty goes up, I want all the Nifty return. If the Nifty falls, I don't want to lose money. So can you give me a product that says, if the Nifty falls in 3 years, I will lose 0%, but that means you will not give me any interest or this thing, but I won't lose any money. But if the Nifty went up, say 40%, you'll give me that 40%. These were created into products called market-linked debentures, MLDs. And because they were debentures, they were taxed as debt. But there's a very interesting point over here. MLDs were bonds. Therefore, bonds are taxed at 10% on gains if held for a year. All you had to do was list those debentures. Now, you could get returns of the Nifty on the upside with a 10% tax. And there was no downside because the downsides were protected. If you build this same product using a combination of, say, a Nifty future and a put option, this is still possible for you to do. You will still get the same tax advantage I'm talking about, except if in certain circumstances, of course, the tax rates may be slightly different. But what I would say over here is that if you use a market-linked debenture now, you will get taxed on the entire thing as income without getting any of this indexation 10% kind of rate. So effectively, the same product gives me a much worse taxation, because otherwise I could have invested in the Nifty, gotten the upside, used a put option to offset the downside, and I would get protected both ways. And if the Nifty goes up 40%, you'll make 40%, on which you'll pay only 10% tax after 3 years. But if you did this through a market-linked debenture now, on that same 40%, you will pay income tax as if it was your income. So you'd pay 33%. So it's become now a much worse thing to do it through a mutual market-linked debenture than to do it yourself in your own books. Gold. Now, that's a very interesting point because gold's gone up quite a bit recently. Any gold fund is taxed now as income, regardless of whether you hold it for 1 year, 5 years, 10 years. This is for new investments made after March 31st, 2023. Which means that your investment profile, if it contains gold, should have already contained gold. Any new gold fund will be taxed as income beyond this. But there's a specific exemption. That exemption is for sovereign gold bonds. So when I say gold funds, it means they're gold mutual funds. Gold mutual funds now typically have a 1 to 2% load, and that load is used for storage costs and security and all of that stuff. So they keep losing money, and they're not as attractive as buying gold directly. Or what's interesting, you could buy a sovereign gold fund. A sovereign gold bond has the additional advantage that if you hold the sovereign gold bond all the way till its maturity, which is 5 to 7 years, you will get all the returns on gold without having to pay any tax.
Zero.
So that means there's no capital gains tax at all if you hold to maturity. And even if you buy the bond from the market and hold to maturity, you will still pay no capital gains tax. But they pay a 2.5% interest, which is better than owning gold in your house, because owning gold in your house only gives you I don't know, bad feeling
Yeah.
of I can't leave my house without 5 killer dogs that are protecting my gold, which has a cost. But apart from that, they give you this 2.5, but that 2.5% is taxable. So that's the one thing that we have to understand, that capital gains may not apply, but accrual taxes on income apply. Now, you would think this makes sovereign gold bonds super attractive. Everybody should be buying them. Again, like the FD question, it's the exact opposite. India imports more gold in one quarter than I think all of the SGB investments put together so far that have been released by the government. So even though it's the government and people have to trust the government, because if you don't trust the government, why are you in here kind of thing, which is, to invest, to give you your money back. But a government-backed gold fund does not replace traditional gold investments, mostly because I think people like that smell, texture, jewelry, whatever it is that comes out of the gold investment directly. I think, this is where it's interesting, but let's go to real estate. Real estate is the other end of the spectrum. Now, I mean, we can have an entire podcast. We've had probably
I think we have had,
yes, on real estate. But it is amazing how much of a benefit we've given real estate in terms of taxes. Now, I'll give you an example. Let's say there's a new rule that's coming and it's made it less attractive. They said, there's a 10 crore cap on the purchase value for reinvesting capital gains. What does it mean? It means that if you make 100 crores of a profit and you can use it to buy, you can use the capital gains and buy a house. And the entire 100 crore would have been offset till March 31st, 2023. Now they're saying you buy a house for whatever, but allow you to offset only 10 crore worth of gains, maximum. Of course, you have to buy a house. It doesn't just automatically happen. But if you already owned a house and you want to buy one more, you can sell one of the houses that sell a capital gains asset. And there are two sections, section 54 and section 54F. Let me first go to the 54F. Let's say you've got, you have a startup, you've sold it. It's a big thing that you've got. And you've got a big amount of income. You can use that capital gain on that amount that you've received.
Let's say you made, you are the founder, you put in 1 rupee and now you've made 50 crores. Correct. That's huge.
That's huge. So 50 crores is the profit. So the government says, give me 20% of that 50 crores because it's a 20. So you say, no, I don't want to pay the government 20 crores.
That sounds like a decent deal, but okay.
Yeah, fine. Honestly, this, the problem is nobody wants to pay 10 crores after you've
worked so hard. Yeah.
So you're like, okay, let me buy a house. You can buy a 50 crore house. You have to invest everything. So you have to invest the 50 crores, including the 1 rupee you had put in, for your initial investment. But you have to put the entire quantum into the new house. And the entire gains are non-taxable. Now you are no longer allowed to do that.
But
beyond 10 crore.
But what if you didn't want a 50 crore house? Did it still serve any purpose?
Oh, yeah, because you know what? Many of these guys would do this as, we'll put the 50 crores into the house. And now once I buy the house, I have to hold it for 3 years. If I sell it before 3 years, this rule doesn't apply. But if I hold it for 3 years and sold it after, let's say I sold it at the exact same 50 crore value I got it for. Now I have not paid tax at all. First of all, I invested in the house. After 3 years, I've sold it. I pay. So the cost for me is, hey, listen, should I pay the government 10 crores now? You just hold this house for 3 years and assume it will hold its value of 50 crores. And then sell it after 3 years for 50 crores more. Now the government has put a stop to this by saying, listen, max you can get is 10 crores. Now a lot of these 50 crores, 100 crore houses are used by people who make large capital gains to pay. Of course, unless it's Bombay, anything more than 2 bedrooms, you'll pay 10 crores for, right? Yeah. So but outside of Bombay, where normal human beings live, you will not pay that obscene a figure for something like a 2-bedroom house. But when you do pay it, a large amount of the people who did pay it were people who made their money off of stocks and therefore want to reinvest those capital gains. Now that will no longer apply. Now, section 54 is where the interesting thing is. You can have capital gains in any asset class, in gold, in equity, in bonds, in any of those things. Use those proceeds to buy a house. Of course, now it's up to 10 crores, but before it was earlier. Tell me any other asset class that allows you to say, listen, I sold $500,000, dollars or whatever, maybe 5 crores worth of Infosys shares or Wipro shares or whatever it is. And then I'm going to buy TCS shares. Please, I'm not going to pay any tax on this gain that I've made in my whatever I've sold just because I bought TCS shares. And I was like, excuse me, the tax company, first you pay tax and then you talk about whatever TCS shares you want. I don't care. You can buy whatever, any company shares. Company that is going bankrupt also, I don't care. But you're going to pay me the tax first.
Yes.
What the government is effectively telling you is, oh, wait, not TCS shares, you want to buy a house. That's very nice. You can buy the house. And we will not take any tax from you. Why should one asset class get this amazingly... what's the opposite of a stepmotherly treatment? Motherly treatment, I guess. I don't know. It sounds like the opposite of whatever it is.
It's absurd.
Yeah. So,
but this still exists up to 10 crores.
It still exists up to 10 crores. So hopefully that, you'll have to...
So 10 crore houses will be very valuable.
Yeah, slum it in a 10 crore house.
Yeah, no more. Okay.
So, but, where the interesting... rule is this, that the demand at the high end will not be tax reinvestment driven, but
you really need to want the house.
Yes. And honestly, real estate investment is the culture itself has had enough incentive. Like I told you, you can do this stuff up to 2 houses. You don't even need to buy a house to live in. You can buy another house and it would have the same kind of lovely tax treatment. It also gets other benefits from the income tax department, from the RBI, from the banking. So I'll give you an example for banking. There are extremely low risk rates for banking. Now, let's say I told you, Shray, let me go to a bank and take a loan for a business that I own. I want a 10 crore loan. I go to the bank or, things like that. They give me a loan. They'll give it to me at a very high interest rate.
13% or something?
Sometimes 18%, so 16%. 17%. Nowadays, it's about 14-15%. But why would they do that and give me a housing loan at 8.5? The difference is very high. There's a difference in how banks perceive loans based on something called risk-weighted assets. So a bank is supposed to say, listen, if you're given a loan worth 100 rupees, you're supposed to have 15 rupees in capital, 15% capital adequacy ratio, if you may. But they don't consider every loan as of 100 rupees as 100 rupees a loan. They give it a weight. They will say, if it's a very risky loan, there's 100% risk weight. So you lend 100, your risk-weighted assets are considered to be 100 rupees. If you lend it against a house, it was as low as 35%. That means if I give a loan for 100, I can assume that the loan I've given is only 35 rupees. This is a lower risk weight. Now, the lower risk weight comes with a disadvantage and an advantage. Now, the interesting thing about the loans that you're giving against this versus a credit card loan versus anything else is that because of the lower risk weight, I have to put a smaller amount of my capital to give a 100 rupee loan versus if I give a personal loan, a business loan or anything like that. Banks are capital constrained. They have only a certain amount of capital. They have to lend against that. Will they choose to lend to you who's asking for a personal loan or me who's asking for a housing loan? Will be simply that, dude, I can lend to 5 Deepaks but only 1 Shray. Why should I lend to Shray at the same rate? If Shray gives me a 16% interest, I'm happy. Otherwise, I'll lend to 5 Deepaks. So the 5 Deepaks get loans at 8.5%, 1 Shray gets a loan at 16%, which is why it's much more this thing. So you're effectively incentivizing people buying real estate because it is not like if Deepak owned a house and then took a loan against that house to run a business, I would still pay 16%. It's called loan against property. It is not considered a housing loan.
Oh, okay.
It's only if you buy a loan to buy a house. This is almost like, listen, if I took a loan to buy shares of my own company, I would be taxed at 16%. My company can earn a lot more in terms of GST. Blah, 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 blah. The house will sit there and do nothing for mostly whatever. But no, we will incentivize people to buy houses rather than set up businesses.
There's a clear policy bias over here and with its own pros and cons. Renting also has some benefits.
Oh,
right?
yeah. And, in fact, owning and renting both have benefits. So, for instance, you have complexities like, for instance, if you take a real estate loan, you can take part of it. The loan repayment has a principal component and an interest component. The interest component up to 2.5 lakhs a crore for a self-occupied property is non-taxable. And, here's the best part. It is offsettable against your salary income. So this is very interesting because India has 4 heads of taxation: salary, income from house property, which is what it's called, income from capital gains, and income from business or other income, and things like that. So I'll leave those aside. But typically, income made in the capital gains or losses made in capital gains can be only offset against profits made in capital gains. Losses against business can be offset against losses in capital gains, but not against salary income. Right? Nothing can be offset against salary income except our dear friendly neighborhood real estate loan interest payment. So because I am paying loan interest on a house, I have spent 2.5 lakh rupees. Oh yes, sir, please deduct 2.5 lakh rupees from my income, my salary income as well. Nothing else. I can make a short-term capital gains on a capital loss on a security that I've bought, but that is not offsetable against income. So essentially that is there. Apart from that, there is a principal, tax reduction as well, where they say, oh, this loan has a 10,000 rupee principal component and a 90,000 rupee interest component. So 90,000 rupees though has handled by that 2.5 lakh limit. The 10,000 principal component per month, up to 1.5 lakhs rupees a year, it is also deductible against income under the ATC. Of course, you may not need it because you may have kids going to school and all that stuff, but leave that aside. This is the only loan in India where an individual gets a tax benefit for paying back principal. You can see how animated I am about this, but it is how it, if you rent, and renting is considered to be not ownership thing, but I would say this is actually the only positive that they have given renters is this. Let us say you buy a property and rent it out. The renters themselves get an HRA tax exemption, which is reasonable because you can structure your tax so that this thing is good. But to the guy who is renting a property, they get 30% off of all the rent they have received by saying that 30% was my expenses against the property without having to give any receipts or proof that you have actually spent the 30%. So let us say you have a property that's making 50,000 rupees a month, which is typically a half bedroom apartment in Bombay. So if you have 50,000 rupees per month, and you may not maintain it at all in Bombay, they don't maintain apartments for the most part. So at 6 lakh rupees per year, you can add only 4.2 lakhs to your income. The 1.8 lakhs is considered, we have spent on the maintenance. I don't have to prove anything. Very rarely is there anything else in the Income Tax Act. Now there is something for businesses, but you can't buy shares and say, no, 30% of whatever dividends I received, no, I spent on fuel, going to my CA to talk to things. No, we don't care. Please pay tax on that entire thing. You can't say I received FD interest of so much, but I had to go to the bank every 3 days. I spent so much money going to the bank. They don't care. They're going to tax you on the interest regardless of what. So again, another benefit to real estate is if you rent it out, you get another benefit as well compared to most other asset classes.
I'll come to the last couple of ones I have. So startups. I mean, people made a lot of money with startups and now I guess are losing a lot of money in startups or seeing that go away. How does that get impacted by taxes?
Yeah, in fact, so startups, even though they're risky now, what the government has done is reduce the holding period to just 2 years. They've said, you've got a 2-year holding period after which you'll get long-term capital gains tax. Long-term capital gains tax allows for indexation of inflation and so on.
They allow that in startups.
They allow that in startup. So it's not taken away for startup investment. Yet. So, but a lot of people own something called compulsorily convertible preference shares.
CCPS.
Now, we're not sure about this per se, but it might end up being that the tax period restarts on the day of conversion as well. Depending on the kind of conversion that happens. If you have to pay some money for the conversion, then there'll be some offsetting thing and all that stuff. But if that is the case, that there's one more thing that you have to be careful about the holding period, because less than 2 years from the date of purchase or maybe conversion. I'm not sure about the conversion part, but assuming that is an element that you have to consider, that may be the key point about whether selling exactly after 2 years or a few days before and after makes a difference. But this is the bigger thing. When a startup goes bust, basically the founders are done with it. People are vanished. It's a dead company. You may continue to own shares. Now, the problem is you may have invested, say, 5 lakh rupees in the startup and now there's nobody left in the company. According to the income tax department, you've invested 5 lakh rupees in the startup. And you can't go tell them, I've lost 5 lakh rupees. I said, well, have you sold the shares? No. Then how have you lost money in the startup? Well, it doesn't exist. I mean, no, the company exists. It is very difficult to kind of unwind the entire company. It's more complicated to do it. Now, you're like, dude, I lost 5 lakh rupees, but can I please offset some gains I've made somewhere else? Because you can. What you should do then is, before the company goes bust, you should talk to the founders or to somebody, even in fact, talk to the before they shut it down. They say, listen, I'm going to sell this to my spouse. And when I sell it to my spouse will buy it for 1 rupee per share, or nothing, 0 rupees per share, or some very, very small amount per share, because the company is worth nothing. It's going to go bust. So when they do that, they just record the transaction in the company statement that this share has been transferred. You just have to prove that the company went bust, and therefore there's not much value left. The minute you do that, you can then claim the amount as a capital loss. And that loss can be offset against anything else, that may be debt fund gains or something else that you have, which is in the same thing. Remember, of course, long-term capital losses can only be offset against long-term capital gains. So you need long-term capital gains to be able to offset it. So maybe debt funds are not what you want to offset it against. It's not possible, but you can offset it against equity gains where you would have paid 10% otherwise. This also can be carried forward. So if you don't have a gain right now to do anything about it, you can carry it forward for another 8 years. Eventually, when you do have long-term capital gains, you can use that, to offset.
Fair. I think coming to my last few ones. AIFs and ETFs, kind of like cousins and mutual funds.
Cousins and other parts of the spectrum. Yeah. So AIFs are very disproportionate in terms of taxation. Okay, AIFs are typically formed as trusts. Now, why are they formed as trusts? They don't need to be. They can be formed as LLPs or companies. But in an LLP or in a company, getting new investors is a very complicated concept. So if I keep on selling units of an AIF, I try to sell the AIF to multiple people, I cannot just issue them new shares or make them new partners in an LLP, because it requires all the existing partners or existing members to allow me to get them to sign up. So people create them as trusts. Now, trusts have a very bad taxation element. Any income that is not capital gains is taxed at the highest marginal tax rate,
which was 43
last year. Now it's 39 apparently. So any F&O income, because an AIF is allowed to leverage using F&O, futures and options income is taxed at 39%. Interest that they receive on any bonds that they buy is taxed at 39%. In case you're going short, let me give you an example of this. Okay, so it's so disproportionate that it's all screwed up. So let's say you've created an AIF that says, listen, I have one portfolio that is long. It's sitting in a long demat account, and there's a portfolio that is short that's sitting with a different brokerage in a long short kind of portfolio setup. So you have a situation where if you've invested 100 rupees and the fund manager has hedged it completely, right? They've taken 100 long positions. That's 100 shares of 100 rupees worth of shares in some demat account, and shorted futures of the same stock in another account, in another trading account. Futures and options are not in demat, so you have to use a trading account. Let's say the 100 went to 50 in a year. Now what happened? Your 100, which was in the long, has gone to 50 rupees, is not realized. It's still sitting there, so there's no loss, no gain. However, the futures and options, where the gains have to be realized, have gone to 50 rupees in profit. The government will say, you made a 50 rupee profit in your futures and options part of the trade. This is considered as full income, and you will pay 39% tax on it. So you're saying, well, you know what, you will pay 43%. I mean, till last year you pay 43% of 50, 21.5 lakhs. Your portfolio is now not 100 anymore. It was hedged. It was supposed to be hedged, but the taxation took over 21.5. So you end up with only 78.5 lakhs. You've lost 21%, even though the market has fallen 50. You were fully hedged, and you still managed to lose 21%. Market goes back up. if it goes back up from 50 to 100, F&O has a loss. But the F&O loss cannot be adjusted against past profits because you already paid tax on them. You have to wait for another day when F&O reverses, and it's only offsetable against future gains. So the differential is such that eventually when the AIFs have to reveal their tax statements, they will give you the statements only post-tax. And the post-tax returns to you will sound like, dude, what the hell? You were fully hedged and what happened? It sounds like, they did everything right, but they got everything wrong in terms of taxes, right? So and we know of a number of AIFs who got affected by this. So a lot of AIFs say simply, this F&O we can't do, we won't do. We will only do long only, but slightly leveraged trades once in a while, but not enough. But this concept of going 50, 100 long and 100 short exactly can be done by an arbitrage mutual fund, which pays no tax at all. So you invest in an arbitrage mutual fund, you are considered to be investing in an equity fund, which has only 10% tax after a year. So if you invest in an AIF, the AIF ends up paying 39 to 43% tax. If you invest in an arbitrage mutual fund, the mutual fund pays no tax, but you will pay taxes when you exit of only 10%. So the same thing done by a different vehicle is somehow different. Of course, you could do this in a low income tax bracket. So for instance, you up to 7 lakh rupees, there is no tax at all. Which means if you are getting 10% somewhere, you could invest up to 70 lakhs rupees in it in an account where there is no other income. This may be an account of a child who has just turned major. That entire
so
money,
there's no income.
So there's no income tax up to 7 lakh rupees. But taxation really impacts a lot that you do. In fact, the concepts of ETFs in the US came about on a tax arbitrage. A mutual fund in the US has to pay tax on any transactions the mutual fund itself also does in the year. So if it buys and sells a stock and achieves, let's say, a $5 profit, the AUM is $100. That means the $5 accrues to all unit holders of the mutual fund on the day that it happened. So what the mutual fund does is every year it will say, listen, your portion of my intermediate taxed transactions is so much. So your capital gains are $100 based on number of units you have, or $200 based on number somebody else has. So each person gets an individualized statement saying you have so much in terms of taxes. And ETF does some strange thing. I think this was discovered by a bank or something, that now they do it regularly with the ETFs. If you issue units to an investor, the issuing of units and redeeming them, the nullifying of units and all that stuff, there's no capital gain involved in all of this stuff, and therefore the ETF doesn't actually transact in the individual stocks. It just redeems and units for stock it owns and buys stock and gives units, right? So the ETF investor pays no tax because the ETF itself is not doing any buying and selling of securities. It's only redeeming units for stocks and stocks for units. This tax loophole has made US ETFs insanely more attractive than mutual funds. India has no such thing. So therefore, we have a weak ETF market, right? So here's another benefit for ETFs in India, but nobody knows about this. If you sell a mutual fund, you pay 0.25%. This is roughly means if you send 1 crore rupees worth of mutual funds, you will pay 25,000 rupees. Equity mutual funds, you will pay 25,000 rupees.
STT?
STT.
Okay.
So 1 crore of
mutual
funds is 25,000 rupees of tax, STT. 1 crore of stock market purchases or this thing is only 10,000 rupees, but they pay both on buy and sell. In mutual funds, it's only when you sell. Now, for an ETF, the same transaction, the STT is only 0.001%. So 0.001% is 100 rupees for every crore. So effectively, it is 1/100th what you'll pay for buying a stock and much lesser for buying a mutual fund. Now, this may sound like a very big advantage, but the numbers are so small. 25,000 rupees on 1 crore versus 100 rupees on 1 crore. It sounds a little too small for people to kind of worry about.
Also, ETFs have slippage and this brokerage and stuff like that. Yeah.
Yes, and ETFs are really attractive because in institutions. So in any mutual fund, there's only a 10%. There's a 10% limit maximum that you can own in any mutual fund is 10% of the fund. So if the fund has an AUM of 500 crores, you can only put 50 crores in it. However, in ETF, there's no such restriction. So SBI ETF, for instance, more than 90% of that ETF is owned by one institution called the Employee Provident Fund Organization, the EPFO. So now, interestingly, there is a stamp duty now if you invest in any mutual fund. It's more complex when debt funds are involved, right? So what would happen in a stamp duty is you would pay a small amount. That small amount added up to roughly annualized of 1.8% per year. Now, if you look at maybe March 2022 or February 2022, interest rates were 4.5%, and liquid funds would give you 3.2% roughly. And if you look at the returns of 3.2% for the whole year, and if I were to buy it today and sell it tomorrow, the stamp duty on the buy transaction itself would cost me so much that more than half my returns are taken away simply because I have to pay this stamp duty on the fund. So many times it just didn't make sense to have any overnight kind of products. You had to have a minimum of 3 or 4 days for you to earn reasonable returns. Otherwise, you are paying most of your returns to the government in terms of stamp duty itself. So taxes does impact that. So a year back, we were telling people don't bother with overnights. Now we're saying overnights make sense because they're earning 6.5, which is much higher than the stamp duty.
I think the last asset class or category of investments on my list is foreign investing. And I know this has been hurt quite badly. There's a new TCS, there's always the terrible tax rules, and there's no indexation now at all, right? Perhaps. So how's foreign investing looking?
So I think, interestingly, because we keep talking on Indian equities and Indian stock markets and all that stuff, they are more attractive. They're probably more attractive stocks abroad as well. But they've kind of said, listen, all these transactions where you invest abroad, you need to pay us 20% upfront. Now, why have they done this is because apparently they're getting a lot of people doing these transactions who don't report any taxable income. So they're like, how are you investing abroad when you have no taxable income? So you know what? Forget the fact that you don't have taxable income or you don't report it. Let's do this. Let's take 20% of whatever money you've invested abroad as a tax upfront, and that tax upfront will get adjusted against whatever tax you have to pay eventually anyways. So if you have a considerable amount of actual income that was you should have been faithfully declaring, now you need to be able to declare that income so that you can take this tax back, right? So it's tax that's gone, and unless you give me a nil return of income, in which case I'll question how the hell do you have money to invest abroad. If you declare a certain amount of income, you can assume that this tax is paid in advance against that percentage of income. But what happens normally? People who have salaries, who are normally good taxpayers, are also affected by this. That means if they invest abroad, they have to pay an additional 20% and they have to claim it back. Now, you work in a small firm like Capital Mind. In Capital Mind, we are very flexible with everybody. So if people come in to us and say, you guys, I've invested so much money in this thing, they have deducted, say, 50,000 rupees of TCS. We'll plug it into our payroll software and say, you know what, this person's already paid 50,000 rupees of TCS. Don't reduce the amount of TDS that we deduct from his salary every month to correspondingly reduce the amount of tax he has to pay. We're fine. But look at large firms. If you go to these Wipros and TCSs and all that stuff, they have 100,000 employees plus. They're not going to we're not going to make any changes to our payroll just because you have paid a TCS. Of course, they should, but I don't think that's happening forthcoming reason. So you have an issue now that you have to now wait to file your returns, claim a refund, explain to the taxman why you need a refund if they have to do this, and you need to have more capital. It's just a cash flow problem. That means if you're investing for 100 rupees, you need to have 120. I think investing abroad through an Indian mutual fund also has limits because you hit RBI limits of, I think they have got $7 billion. So you can't invest abroad through Indian mutual fund. I think, for instance, you're not discussing today the fundamentals of Amazon, Meta, Google. They have great cash flow. None of that matters. Dude, if I invest in them, I have to pay 20% extra versus investing in TCS. I don't have to put 20% extra. So it's not about the fundamentals anymore. It's about the fact that one is allowed and has, both are allowed, of course, but just that one has a higher tax paid at source. So I think, if over a period of time, people keep telling us, that taxes don't matter in investing. You just choose the best investment. The answer seems to be, no, it does matter. And there are all these little things which either make sense from a rational investment perspective, saying, dude, yeah, man, I can't give up this 1.5% extra just because of the tax difference. I have to include it in my thought process and so on. So yes, I think taxes, while they matter, we actually also have to say that, okay, Indian domestic equity also is in relatively, say, better shape. 5-year volatility is 5-year. It's literally saying, take your money now, close your eyes for 5 years and look at it after 5 years. Then your volatility is not as bad as you think. Equity remains the best investment. Indian equity, domestic Indian equity remains the best tax-wise investment available in India. But I would say if you can't do that, I would say just defer your taxes. Defer as much as you can. Don't keep paying on accruals when you don't need money. So the FD is still the worst investment product. So you might still want to consider debt funds. You might even want to consider insurance product up to 5 lakhs. Since they're giving you the limit of 5 lakhs, why not use it? So create those, look at those products where the guaranteed returns are high enough to say post-tax, I want to make a very reasonable return. And consider eventually that you will be at a lower tax regime if you manage your assets properly. So I think, taxes matter, and perhaps unreasonably so, because these sound like, unnecessary exemptions or unnecessary removal of exemptions in certain cases. But overall, I think in the long term, the lower tax but higher volatile products, on the sound of it, equity, tend to make better post-tax returns.
Well, Deepak, thanks very much. I think that's a very comprehensive take on all the asset classes and that most of our customers care about, and the taxes that impact them. And I agree with you. The taxes do matter, and these are pretty big numbers and pretty painful cash flow events. So on that, thank you very much.
Thanks so much.
Well, that ends today's episode. If you like how we think about this stuff, then do visit us at capitalmind.in/podcast to see more of our episodes and see if any of them catch your fancy. And if you have any suggestions, feedback, or ideas for new episodes, or just in general, then send us over an email at podcast@capitalmind.in. Happy investing!